Welcome to Wealthfinity. In this video, we're going to be discussing the latest trends in personal finance and investment strategies to help you build and grow your wealth. Whether you're just starting out on your financial journey or you're a seasoned investor, there's something for everyone here. So sit back, relax, and let's dive into the world of building wealth together. The United Kingdom has a long and rich history of inflation, with rates fluctuating significantly over time. Inflation is a measure of how much prices for goods and services are rising over a period of time, and is usually measured by the Consumer Price Index, CPI. In the UK, the Office for National Statistics, ONS, is responsible for measuring and publishing inflation data. The United Kingdom's inflation rate is a crucial indicator of the country's economic health, and monetary policy plays a significant role in determining its trajectory. Monetary policy refers to the actions taken by a central bank, such as the Bank of England, BoE, to control the money supply and interest rates in order to achieve specific economic goals. In this video, we will explore the impact of monetary policy on the UK inflation rate and how it affects the broader economy. The BoE's primary goal is to achieve price stability, which is defined as an inflation rate of around 2%. To achieve this, the BoE sets interest rates and conducts open market operations to control the money supply. When the BoE raises interest rates, it makes borrowing more expensive, which can slow economic growth and reduce inflation. Conversely, when the BoE lowers interest rates, it makes borrowing cheaper, which can stimulate economic growth and increase inflation. In recent years, the BoE has used monetary policy to combat the negative effects of the COVID-19 pandemic on the economy. In March 2020, the BoE lowered interest rates to a record low of 0.1% and launched a massive asset purchase program to inject liquidity into the financial system. These actions were intended to support businesses and households and prevent a severe recession. However, these measures also had an impact on inflation. The sharp fall in oil prices in 2020 led to a temporary drop in inflation, but it started to pick up again as the economy began to recover. The BoE's asset purchase program also contributed to an increase in inflation by increasing the money supply and pushing up asset prices. In the early 20th century, inflation in the UK was relatively low, averaging around 1–2% per year. However, this changed during the two world wars, as government spending increased dramatically and the supply of money in circulation grew rapidly. This led to high inflation rates, with the rate reaching a peak of 26.9% in 1920. After World War II, inflation in the UK began to decline again, falling to around 2–3% per year in the 1950s and 1960s. However, in the 1970s, inflation rose again, reaching a peak of 27.7% in 1975. This was caused by a combination of factors, including rising oil prices, increased government spending, and a strong labor market. In the 1980s, the government of Margaret Thatcher implemented policies to bring inflation under control, including raising interest rates and reducing government spending. These policies were successful, and inflation fell to around 5% by the end of the decade. In the 1990s and 2000s, inflation in the UK remained relatively low, averaging around 2–3% per year. However, in the wake of the 2008 financial crisis, inflation rose again, reaching a peak of 5.2% in 2011. This was caused by a combination of factors, including rising commodity prices and a weak pound. In recent years, inflation in the UK has been relatively low, averaging around 2–3% per year. However, with the ongoing Brexit uncertainty and the economic impact of the COVID-19 pandemic, it remains to be seen what the future holds for inflation in the UK. One of the main reasons for the recent rise in inflation is the impact of Brexit. The UK's decision to leave the European Union has led to uncertainty in the economy, which has resulted in higher prices for goods and services. This is because businesses are having to pay more for imports, as tariffs and other trade barriers have been introduced. Additionally, the weaker pound has made it more expensive for businesses to import goods and materials, which has led to higher prices for consumers. Another reason for the recent surge in inflation is the increased cost of goods and services. The cost of food and energy has risen significantly in recent months, which has contributed to the overall increase in inflation. This is partly due to the higher costs of raw materials and transportation, as well as the increased demand for these products. Additionally, the ongoing COVID-19 pandemic has led to supply chain disruptions, which has further pushed up prices. The recent rise in inflation is also a result of the government's policy of increasing the national living wage. This has led to higher wages for low-paid workers, which has increased demand for goods and services. This, in turn, has led to an increase in prices as businesses try to recoup their costs. It's important to keep an eye on inflation rate, as it can have a direct impact on personal wealth, savings and investments. It's important to have a well-diversified portfolio that can help to mitigate the effects of inflation and to consider inflation-protected investments such as index-linked bonds or inflation-linked savings accounts. It's worth noting that monetary policy alone can't target certain level of inflation. It can only try to achieve it by manipulating the money supply and interest rates. Also, the inflation rate is affected by various other factors such as supply and demand, international trade, and fiscal policy. In conclusion, the UK inflation rate has a long and complex history that has been influenced by a variety of factors. Recently, there has been a surge in inflation due to supply chain disruptions caused by the COVID-19 pandemic and Brexit. Monetary policy, specifically the actions of the Bank of England, plays a crucial role in managing inflation and maintaining economic stability. Understanding the history, reasons for recent changes, and impact of monetary policy on inflation is important for individuals and businesses to make informed decisions.